Hello and welcome to this special report here at XM.com. We'll be taking a look at what markets are expecting from the Fed in the coming months and the outlook for the dollar. I'm Maria Bashardis, and joining me is lead investment analyst Rafi Boyajian. So Rafi, recession risks and a Fed pivot have been concurrent themes for some time now in the markets. We still have no clarity about whether or not there's going to be a recession in the US, but we did finally get hints of a pause from the Fed. Yet, even on that, we're seeing some doubts emerging. Do you think the markets have got it wrong about the Fed?
Well, Maria, like you said, there's been a long-running theme of when the Fed is going to pivot. And one of the things that's been guiding the markets in terms of the market implied rate path has been the Fed's own median projection that they publish in the dot plot. And usually, markets do follow the Fed's guidance fairly closely, but it's not the sole thing that markets look at. They look at other indicators and they make up their own minds. And more recently, the market expectations have been pretty out of lockstep with the Fed's own projections. And we're seeing investors betting that the Fed will begin cutting interest rates in the second half of this year, which is not actually that far away, whereas the Fed has been insisting that rate cut is out of the question in 2023. And one of the reasons that's why markets are convinced that the Fed will cut rates is that they're fearing a recession in the US. Initially, it was concerns that the Fed was going to over-tighten, that was going to lead to a recession. Now it's this worry that the banking crisis will lead to some kind of a credit crunch in the US because there is some evidence suggesting that banks in the US are lending less. So that's a bit of a concern. But we did, though, get finally from the Fed some kind of signal that they may pause at their next meeting in June. Now, this signal wasn't quite the one that traders had been hoping for because the Fed did keep the door open to a rate hike. So it wasn't a firm pause signal. And the reason for that is because the data out of the US remains fairly strong. The US economy, yes, it seems to be slowing, but not slowing fast enough. Particularly the labor market remains fairly resilient. And so this is not just causing markets to kind of doubt their own projections about the market implied path, but we're also seeing some divisions within the Fed. We've had a number of speakers recently in recent days, some saying that it's too early to pause, whereas others saying that actually we should pause and see, allow the previous rate hikes to feed through the economy. And so now we are finally seeing, because of this renewed hawkish language, we are seeing markets starting to scale back some of their rate cut predictions for the second half of this year.
And what about the dollar? It appears to have come back in favor lately, but what does the outlook hold for the rest of the year? Should we expect more upside or downside?
Well, the dollar has been gaining quite a bit of traction over the past week or so. It actually climbed to 5-week highs against the basket of currencies and the euro as well. But it's too early to tell if this is a trend reversal or an upward correction. Now, part of the reason why the dollar has been doing so well is because it's been attracting quite a bit of safe haven flows. The dollar, of course, is it is a safe haven currency along with other currencies such as the yen. And that's been due to the fact that we've had, for example, renewed concerns about a recession or a major slowdown in the global economy, mainly because of some poor data coming out of China and Germany lately, and the overall uncertainties that just keep lingering in the background. But I think even if the dollar does continue to gain traction, some further positive momentum, it's doubtful whether or not it would be able to go that far, perhaps as far as the peaks we saw in the dollar in March before the banking crisis. And the reason for that is because the Fed will have to pause sooner or later. I think we're sort of mainly talking about whether it's going to be next month, next meeting, or the one after that. And the Fed we have to remember that the Fed is ahead of the tightening cycle than many other central banks, such as the ECB, Bank of England, and Bank of Japan, which hasn't even started to tighten policy. So even if we were to dismiss any prospect of a rate cut, it's only a matter of time before we see this monetary policy divergence between the Fed and ECB and BOJ and a few others. And at that point, the dollar will begin to struggle. However, that doesn't mean to say that we should expect the dollar to decline to the low levels we saw during the pandemic. For example, at the beginning of 2021, there are still plenty of risks out there. For example, the slowdowns we just talked about in China and Germany. And unless the banking situation were to get a lot worse and we were to see some kind of a credit crunch in the US, the economy should continue to remain relatively resilient. And it's unlikely the Fed would cut rates significantly, even if inflation does get closer to the Fed's 2% target because of basically the very strong labor market that we have in the US.
Rafi, thanks so much. And thanks for joining us for this special report here at XM.com.